If you want to see what a massive, undeniable earnings beat looks like in the financial sector,
Yeah.
look at Allstate today, ticker
Oh,
AO3.
absolutely. It was a monster print.
Yeah, they just dropped an adjusted earnings per share of $8.99 for the second quarter of 2026.
Which is just wild when you look at the street estimates.
Right. I mean, that completely obliterated Wall Street's expectations. They were sitting in this, rather pessimistic range of $5.18 to $5.76. So we're looking at a roughly 79% beat on the bottom line.
Yep. And the top line was strong, too.
Exactly. Revenue hit $18.6 billion, so that's up 11.8% year over year.
And, management held back on issuing hard numerical forward guidance, but
But they strongly signaled expectations for continued growth, right?
Yeah.
In both policies and their protection services segment.
right, they did. But what's fascinating is we still have analysts actively projecting a forward EPS deceleration despite this print.
Which we will definitely get into. But the market response, it is immediate. Shares popped 4.27% the day after the report.
Trading up to what, like $273?
$273.77. Putting the stock right near its 52-week high of $277.22.
Those are just staggering headline numbers for, a legacy insurance carrier.
Yeah, they really are.
When you see an earnings beat of that magnitude in a mature industry, the immediate question for any analyst is this driven by core operational excellence or one-time accounting benefits?
So that's exactly the mission for this deep dive into the earnings materials today. We're going to unpack that exact question.
Right.
We're going to go through Allstate's Q2 filings, their management commentary, and the latest analyst notes, all to figure out how they achieved a massive 44.2% return on equity over the last 12 months.
Which is a huge number.
And we also need to understand why, despite this massive beat, some Wall Street analysts are actively downgrading the stock to a sell.
Yeah, it's a really interesting divergence. But to understand the bottom line, you really have to start with the core engine of the business, right? Property liability underwriting.
Let's do it.
So the headline metric here is the earned premiums. Those came in at $14.9 billion for the quarter.
Which is a solid bump.
Yeah, that is a 4.0% increase year over year.
And driving that premium growth, it isn't just rate hikes, it's actual policy in force growth.
Right, the volume is actually up.
Exactly.
Uh-huh.
They grew total policies in force by 3.8% to almost 216 million. So they aren't just squeezing a shrinking customer base for more money. They are actively expanding the pie.
But the real story, however, is what happened to the profitability of those premiums. The recorded combined ratio for the property liability segment dropped a full 4.5 points, down to 86.6.
Just to frame that up for a second for you listening, a combined ratio of 86.6 means that for every single dollar Allstate takes in as premium, they're only paying out 86.6 cents in claims and operating expenses.
Right.
So that leaves 13.4 cents of pure underwriting profit on every dollar.
And when you apply that 13.4% margin to $14.9 billion in premiums, you arrive at the $2.0 billion in underwriting income they posted for the quarter.
Wow.
Yeah, that is a massive operational jump from the $1.3 billion they saw in the prior year quarter.
Let's isolate the specific product lines here, starting with auto insurance, because that's where the accounting gets incredibly interesting.
Very interesting.
The recorded combined ratio for auto improved 2.7 points to 83.3. And they grew policies in force by 2.8%, plus they saw an 8.8% spike in new business.
But here is the critical detail buried in those filings. This quarter benefited heavily from 2.4 points of favorable prior year reserve development.
Right, let's hover on that because that specific detail is really the pivotal factor in this entire earnings report.
It really is. I mean, for the full year 2026 so far, Allstate has seen $1.5 billion in auto reserve releases.
$1.5 billion.
Yep. And 51% of those injury coverage as reserve releases are coming from the 2023 and 2024 accident years.
Okay, let's unpack how this actually works. Releasing $1.5 billion in prior year reserves. Is this the financial equivalent of putting your hand into the pocket of an old winter coat and finding a $100 bill?
That's a great way to put it, actually.
Because it's a fantastic one-time windfall, right? It pads your wallet today, but it doesn't mean your actual salary went up. Or does this massive reserve release represent a structural, sustainable improvement in how Allstate is predicting risk?
Well, the winter coat analogy captures the risk of over-extrapolating this quarter's EPS perfectly. When an insurer releases prior year reserves, It just means the claims from 2023 and 2024 ended up costing much less to settle in reality than their actuaries originally estimated a few years ago.
Because actuaries are paid to be conservative.
Exactly. They held excess capital against those pessimistic estimates. Now that the dust has settled on those old car crashes, they are recognizing that excess capital as pure profit today.
Got it.
So it flatters the current quarter's earnings tremendously, but it is entirely backward-looking.
So they were overly conservative in the past, and now they are reaping the accounting benefit of that conservatism all at once.
Basically, yeah.
So if you're looking at this as a potential investor, you can't assume they're going to find a billion-dollar bill in that winter coat every single quarter.
You definitely can't. But if you want to strip away that noise and see the true current operating performance, you have to look at the underlying combined ratio.
Right, the metric that excludes catastrophes and those prior year reserve releases.
Correct. For Q2, the underlying auto combined ratio was 87.6.
Which is still an incredibly strong number for an auto insurer in this environment.
Oh, it absolutely is. It shows that the core auto business is highly profitable on its own merits today, improving by 0.2 points from the prior year.
So the core engine is running efficiently.
Yes, but any analyst building a forward model has to acknowledge that the $1.5 billion reserve release, it turbocharged the headline earnings per share to levels that just aren't strictly replicable from daily operations.
Okay, I want to look at homeowners insurance next because this segment engineered a massive operational swing.
Oh, it was huge.
Right. Last year in Q2, they posted a $76 million underwriting loss. This quarter, that flipped entirely to a $226 million underwriting profit.
The turnaround is striking on the surface, for sure. The recorded combined ratio for homeowners improved by a massive 7.4 points, bringing it down to 94.6.
But a huge driver of that swing was simply better weather, wasn't it?
Yeah, mostly luck.
Catastrophe losses dropped 12.8% to $1.4 billion for the quarter.
Yeah.
I mean, when the weather is calmer and fewer roofs are being torn off, insurers naturally keep more of their premium.
Yeah.
We also saw a 16.4% jump in new business in this specific segment.
But here's the catch. If we apply that same underlying logic to homeowners,
Trooping out the catastrophe luck.
exactly, just looking at the daily cost of doing business, the underlying combined ratio actually went up by 2.9 points to 61.5.
Ouch. That feels like the hidden pressure point in the entire segment.
It is.
Management noted in the commentary that higher loss costs drove that underlying ratio up. The cost of materials, the labor to rebuild homes, the supply chain for specialized parts, it is all still exerting pressure.
Inflation is still very real there.
Yeah. They managed to outrun those costs this quarter by pushing through a 5.8% increase in average gross written premiums. But the underlying inflation in physical replacement costs, like you said, it's still very real in the data.
Still, strong underwriting across both auto and home generates cash. It creates what the industry calls float.
Right. Essentially, billions of dollars in premiums that customers have paid up front, which Allstate gets to hold and invest before they ever have to pay it out in claims down the road.
Exactly.
So are they playing it safe with that cash, or are they taking massive risks to juice their returns? Because when we look at the balance sheet, Allstate is currently sitting on an $87.8 billion investment portfolio.
It's massive.
And in Q2, net investment income surged 33.8%. That translates to an additional $255 million, bringing total net investment income to a clean $1.0 billion for the quarter.
So to answer your question, they are essentially running a barbell strategy with that float.
What do you mean?
It's like they have two entirely different investment teams. On one side, you have the tortoise. This team is buying boring, high-yielding bonds and market-based fixed-income securities.
You safe stuff.
Right. That side of the portfolio generated $837 million of highly predictable cash flow. The higher-for-longer interest rate environment has been a massive tailwind here. As older, lower-yielding bonds mature, Allstate simply takes that capital and reinvests it into higher-yielding assets.
Okay, but then you have the other side of the barbell, right? The hair.
Yep, the hair.
This is the performance-based income, which jumped massively to $239 million for the quarter, up $160 million year over year.
Huge jump.
The materials explicitly note this was driven heavily by private equity and real estate valuations. I have to push back on this strategy, though.
Go for it.
If you look closely at the filings, 88% of that performance-based income came from just their top 10 investments. Is Allstate acting too much like a concentrated Silicon Valley venture capital firm with a portion of its float?
That's a very fair question.
Because if private equity valuations cool off, or if commercial real estate takes another leg down, this level of investment income looks highly fragile.
Yeah, taking concentrated equity-like risk with insurance float is a totally valid critique. And to be fair, management's own disclaimer in the report acknowledges this reality.
What do they say?
They state outright that quarterly volatility in reported results is expected with these performance-based assets. By concentrating returns in a handful of top private equity assets, they are exposing themselves to the exact valuation swings you just mentioned.
So it's another area, very much like the auto reserve releases, where the Q2 print might just represent peak optimal conditions.
It is entirely possible. However, the scale of the different segments provides necessary context here. While the $239 million from performance assets is undeniably volatile, that $837 million from the stable market-based fixed income, that is the actual bedrock. The overall total return on the portfolio was 2.6% for Q2. It is the boring fixed income portion that gives them the structural stability to take those concentrated swings in private equity without, endangering their ability to pay claims.
Got it. Okay, let's step away from the core insurance and investments for a minute. Allstate has been pushing hard into ancillary revenue through what they call protection services.
Yes.
This includes Allstate protection plans, roadside assistance, identity protection, and Arity, which is their telematics data business. But the narrative in the filings here feels incredibly mixed to me.
It is mixed. Top-line revenues for protection services rose 7.8% to $935 million. That growth was primarily driven by continued expansion in protection plans, both domestically and internationally.
But the bottom line tells a completely different story. Adjusted net income for the segment actually dropped by $7 million, down to just $53 million for the quarter.
Yeah, the margins got squeezed.
And here is the fascinating irony in the data, right? They are phenomenal at pricing the risk of a $50,000 car crashing on a highway, but they're actually losing margin trying to predict when your $500 washing machine will break.
Exactly.
The claims costs on major appliance warranties are actively dragging down the profitability of the whole protection segment.
We are seeing a classic margin squeeze there. They are successfully selling more volume, but the unit economics are deteriorating.
Right.
And looking at the other units, Roadside and Arity both posted double-digit revenue growth. Roadside seems to be benefiting nicely from bundling with their new, affordable, simple, connected auto product line.
Arity.
Arity, despite a 13.6% revenue jump from lead generation advertising, still posted a $7 million adjusted net loss.
Man, it just perfectly illustrates the difficulty of scaling adjacent technology businesses inside a legacy financial firm. Selling the core auto policy is highly profitable, but monetizing the underlying driving data through Arity.
Or managing third-party warranty repair costs on household appliances.
Exactly. It is proving to be a drag on consolidated margins, even as it successfully diversifies their top-line revenue.
And all of this underwriting profit and investment income, it ultimately leads to one place, right? Excess capital.
Yes.
How management allocates this capital and how Wall Street interprets their long-term tech strategy is really the fundamental crux of the current bull versus bear debate on the stock.
The balance sheet strength right now is just undeniable, though.
Yeah.
I mean, in Q2 alone, Allstate returned a massive $1.3 billion to shareholders.
A huge sum.
That breaks down to $1.7 in active share repurchases and $280 million in dividends. And they still have $2.6 billion left on their current $4 billion buyback authorization.
That aggressive repurchasing, combined with the net income surge, it caused their book value per share to absolutely skyrocket. It was up 49.7% year over year, hitting $123.38.
That's crazy.
And when you are analyzing financial institutions, book value is the foundational metric. It represents the literal net worth of the company per share. Growing that by 50% in 12 months completely reshapes how the market has to value the equity.
And CEO Tom Wilson, he is crediting this operational leverage to their transformative growth initiative, right? He specifically pointed to the Ally AI ecosystem.
Yeah, the AI angle.
The filings cite over 250 analytical models and 40 petabytes of data being used to systematically lower costs and enhance value.
See, the integration of AI into underwriting and claims processing is being pitched as a major structural shift by management, not just a cyclical peak.
Right.
If you have 40 petabytes of telematics data tracking braking habits, time of day driving, geographic risk variation, and you can deploy machine learning to price a specific driver's risk more accurately and faster than a legacy competitor, you theoretically permanently lower your underlying combined ratio.
You aren't just riding the standard insurance pricing cycle anymore.
Exactly. You are fundamentally changing the cost structure of the business.
But despite this massive 79% earnings beat, and despite the $1 billion spent on buybacks in a single quarter, and despite this very compelling AI narrative, Wall Street is not universally convinced.
Not at all.
Cities recently downgraded Allstate to a sell.
The skepticism there centers heavily on the concept of peak earnings. Cities downgrade sites that recent operating returns seem, in their specific words, unsustainable.
And the broader consensus estimates reflect this exact skepticism too. For the full year 2026, the EPS consensus estimate is sitting at $30.74.
Which is a drop.
Right. That implies a projected 11.7% year-over-year decrease in earnings. Analysts are actively forecasting a deceleration, openly questioning if underwriting gains can keep pace with soaring policy counts.
The bears on Wall Street are looking at the exact same data points we just discussed and drawing a completely different macro conclusion.
How so?
They argue that the massive benefits of the recent hard market, like the aggressive rate hikes approved by regulators over the last 2 years, are peaking right now. They argue that the $1.5 billion in auto reserve releases is just a lucky one-time accounting boost that will dry up in 2027.
Okay, I have to challenge this bearish outlook based on the operational data.
Go on.
If Allstate is growing policies in force by 3.8% and they're implementing a massive AI ecosystem to systematically cut operating costs and improve pricing accuracy, aren't these analysts just being overly anchored to historical cyclicality?
That's a bull argument, yeah.
I mean, the insurance industry is notoriously boom and bust,
Yeah.
sure.
Yeah.
But why assume a forced reversion to the mean when the company is structurally changing its technology stack
Yeah.
and utilizing completely new distribution channels?
It comes down to a fundamental debate about the limits of technology against physical macroeconomic reality.
Right. Explain that.
The bears fully acknowledge the AI models and the new distribution efficiencies, but they argue these digital efficiencies cannot permanently outrun physical inflation. Think about it. If the underlying combined ratio in homeowners went up 2.9 points this quarter solely because of loss costs, that means the physical reality of replacing a roof, buying lumber, or paying a mechanic to fix a bumper, it's still getting more expensive faster than algorithms can save money.
So the bears believe real-world inflation will eventually catch up, and when that reserve release finally runs dry, the margins will compress. Hence, the projected 11.7% drop in earnings.
Right. The bears see a company over-earning today due to past pricing actions and accounting releases, while the bulls look at the exact same earnings report and see a company utilizing a massive data advantage to forge a permanently more profitable baseline.
Which leaves anyone analyzing this stock with a really fascinating dynamic. The company is generating massive amounts of cash right now, but the market is heavily divided on what the next 12 months actually look like.
Are very divided.
Will Allstate's aggressive share repurchases, spending $1 billion in Q2 alone, will that look like brilliant capital allocation if the Ally AI ecosystem permanently lowers the combined ratio baseline? Or will management deeply regret buying back stock near 52-week highs if the analysts predicting an 11.7% earnings drop are proven right about the insurance cycle turning?
That is the multi-billion-dollar question for anyone modeling this equity going forward.
We will definitely be tracking the data closely as the next quarter unfolds. Make sure to follow the show for daily, in-depth earnings coverage and financial analysis.